Hi back everyone. We're going to work on momentum of the last leg today. I think momentum and the market cycle are the most important piece of trading for any kind of strategy that is out there. So it doesn't matter if you're following indicator system or price action or whatever system you're just following. I think this is the key for the success, and this is the reason that most of the traders just get profitable for a while. Later, they lose their edge because their edge work in just a special kind of market actually cycle. And when they're applying the same kind of strategy in different market cycle, it doesn't work. So, in order to understand market cycle, the basic structure and basic step that you need to know is knowing how to measure the momentum of the last leg. So, by the way, what is momentum? Momentum is in short, speed up uh, price movement. And the formula for that, which I created here, is momentum measurement formula is the range and the price movement, which is changing based on the time. The faster the momentum, the lower the time is, and the higher the range is. So as you know, on the time-based charts, we have candles that they're representing minutes, 5 minutes, 15 minutes, and so on. So it means that if we have a price movement which is fast, the range which is moving very fast in short amount of time, it means that it has fast actually speed, if we call it momentum in trading. So how do we measure momentum now? So is there a way that we can measure momentum? So we have different kinds of different ways of actually measuring momentum. And you could use different kinds of also momentum indicators, which they're not that much accurate. And the most accurate indicator you may use for momentum could be the simple exponential moving average. And I will just get back to it later. But now we're not working on momentum things. So let's go and find out how we can measure momentum without using indicators or anything else by on our eyes. So now we're going to use three last candles of the leg. Yeah, three last bars of the last leg actually in the pattern or structure. So the strong momentum quantifiers are as follow. So if we want to just use the first, the last, very last candle, which is closed. So we're gonna just consider three to four things in one candle, last candle. So if you look at this candle here, in this way. So then you will see that. So here, uh, the size of this candle matters a lot. Okay, bigger the candle range, better the momentum. It means that it has moved. Okay, this range. Okay, in the same amount of time. If you just compare this candle to the candles around this candle, so if it has the large size, it means that it has high momentum with the same amount of time. So this was the range. The second thing is that bar close in the last quarter. Okay, if you just try to divide this range in four parts, so you will see here 1, 2, 3, 4. So because this is bearish momentum, so if we have the close of the market in the last quarter, so it means that it had actually enough momentum and enough strength. Not only it was fast, it went there and it stayed there and maintained its position. And also we need to have a small wick to the body ratio. So it means that this wick up there, okay, and this wick, okay, these two together must be less than the amount of the body, okay? Body must be actually double the size of the range of these shadows, okay? And by the way, shadow must be, or wick must be in bearish candles, must be in upper part, and in the bullish candles must be in the lower part. So close of the candle must be as far as it is possible from the longest wick. This is another criteria. So wick side is away from the close side, as I explained. So this is wick side, this is shadow side, actually the longer shadow, longer wick, and this is the close of our candle. So it means that here, because it is as far as it is possible from the longer wick. So it means that this is a strong bearish candle. So this was one candle analysis of the momentum. Now let's go and have two candles next to each other. So not only we are analyzing one candle standalone, we need to analyze, actually this one related to this one. Now we need to analyze two candles side by side. So this one is easier. So the last candles closed above bullish candles high, if it is actually bullish candle, or the last candle closed below bearish candles low. It means that this is our what? This is our low, and the last candle's close is this one. The close of this candle is lower than the low wick of the previous candle, prior candle. This shows the strength of this movement. So some of the people in ICD, they call this one, if we have the third candle here, and we don't have this overlapping and the gap is not closed here by the third candle. So it means that the high of the third candle and the low of the first candle here in this tree series, so they don't meet, so they call it a fair value gap. So it means that the numbers of the sellers were so many that the amount of the people that they were buying here were way lower than amount of the people that they were selling here. So now, if we want to just see, as you see here, this is the low of the candle, and this is the close of the candle. It is way below the low of the prior candle. It shows the further it is, the stronger it is. But it also, these things are, all of these momentum analysis, everything I'm talking about, are meaningless unless you're just considering context and the structure of the market. Sometimes we have this kind of situation, but this falls just at the end of the channel. So it means that it is exhaustion gap. So although it shows the strength of the chart, momentum, but because the position of the leg is at the end of the channel, upper part of the channel, we call this exhaustion gap, or even at the end of the tight range. So sometimes they lead to fake breakouts so that they trap the traders, or the only reason it was coming down or up was just trying to stop hunting the stops, which was sitting there to provide liquidity to just move on. Now let's go to the third scenario. We are going to compare three candles. So the overlapping of the candles, or in another word, okay, you can say the slope of it. As far as you remember, okay, this is what? This is our midline, and this one was the upper boundary. This one was the lower boundary. So here was our overbought area. This one was our oversold area. Here we have minus 65, 65. This is the degree and the slope, okay? So the downward slope, okay, the sharper it is, the stronger the momentum is. So, and this, bear in mind that this last candles, okay, last candle that these three candles, these are our last legs of our pattern of the structure. Okay, so we're going to break these candles into lower time frame. Like for example, if these candles belong to 15 minutes, okay, last legs chart. So we're going to go down and break it into trend, and we're going to find overbought, oversold area based on the swings there, and also then we are going to attempt to sell. Okay, so now here, as you see here, if we break this down and look at these ones, so again, I'm going back. So if we consider these candles high and low, high and low, high and low, if we connect them like the way you learn in Gann pullback, Gann legs or valid pullback, so you can find out that after connecting these, we're going to have market structures that they also are, these patterns that we have are also candles in the higher time frame. Okay, so it means that momentum plus market structure or pattern gives us market cycle type, and we have different kinds of market cycle, and this is the king in trading. So no matter what system you're following, market structure and market cycle, actually here I should have written market cycle is the king. Why? Because momentum is the king. If momentum is just combined with market cycle, it's going to give you different condition, different context for your trading. So now I have just written here, we have roughly 5 to 6 kind of market cycle. So when we have a very strong one without any pullback in the lower time frame, so this one we can call it breakout, or we can call it spike if it is starting the new phase of movement, so we can call it breakout of the market cycle, which is breakout market cycle or spike market cycle. If it has just candle base, just a small candle base pullbacks, not even 2 or 3 candles. Sometimes it is just one small candle. It is tight channel. So breakout. By the way, we cannot draw any trend line on breakout. It's too difficult and it is meaningless unless you just if it is just 15 minutes candle. You can even go to 1 minute chart and you cannot find any place to draw a chart. And if you want to just draw a channel, you should even go lower than 1 minute candles chart, and you can go to 15 seconds, 10 seconds, or 5 seconds chart to just be able to draw a trend line on that. So it means that the distance between the last leg, which is which has high momentum, and if you want to just go to the channel and turn it into the channel phase, the distance between the time frames will be wider and wider if the momentum is strong. So here again, so as I talked about it, it is tight channel. So this candle-based pullback. So here we have a normal channel. So it has just a very smooth pullback, extension, pullback, extension, pullback, extension. So it usually comes back and retests these areas, and these areas, and so on. And sometimes this area pullback, so this zone of pullback, sometimes they come deeper into the area pullback. Okay, so it becomes wide. Okay, it becomes wider kind of channel, or we could say weak channel. So it is not necessarily wide, but usually it is wide. So it comes here into the zone, goes up again, comes back to the zone, goes up, comes back to the zone, goes up, and so on. So far, we have talked about 4 of these market cycles, okay? Each of these market cycle has its own way of trading. For example, if you want to just go, let's say, here, for example, you're just buying on the close of the market and close of the candle. So if you do the same here on the close of the candle, if you do the same kind of behavior that you have in the spike phase here, so because you don't know this is going to happen afterwards, so your stop will be easily hit here. So if you put your stop behind candle, as you do it here, so your stop will be hit, okay? And if you want to just do this kind of behavior for this, for example, if you enter here and you put your stop behind the most recent swing, so if you want to do that, if you want to enter here, you cannot find any place to put your stop, okay? There is no swing around there, okay? So these are, even if you put them here, okay, it is going to be very far and big stop loss. So now this is the way that it is shown in the higher time frame if you want to just look at it in a GAN leg way. And this one is another one. This one is another one. If you can look at the slope of this legs here, as we go to the right side, you'll see that the slope is getting, this one is sharper, this one is getting weaker and weaker, and now we have the weak one. The weakest one is here, wide channel. Okay, so also this is very important. Just this part is very important to know. Each of them has kind of its own bias. In the breakout phase, we only just look for a reason to buy. It could be in the close of the candle, it could be in the shadow of the candle, it could be anywhere that you think like there's an opportunity to buy. You just convince yourself to buy. This is very important to have a bias when you want to buy, when you want to trade. You have to first of all identify market cycle, which is the hardest thing for traders, because market cycle is the context that you're trading based on. And the second thing is that you have to just for each of this market cycle, you have different kinds of bias. Okay, in the breakout phase, you're just looking for any reason to buy. In tight channel, again, you're gonna buy. Okay, so you're just going to be buying based on the pullbacks, or you're looking for one small candle, actually reversed candle, or if it is bullish trend, so you're looking for a bearish one candle, small candle as pullback to buy. In normal channel, you usually just buy, okay, but you're buying it low, okay, not anywhere like a spike. You buy it anywhere it is possible, or in tight channel with a small bar-based pullback, you want to buy it. But here you have to wait for the price to come to the lower areas, okay, not further than this swing or further than this swing, okay. So it could be around this area, okay. And for this one, you can buy low, and sometimes you sell from this side to the low part, okay? But 60%, even 70% of the time, you're just looking for the buy. But sometimes you can sell as well because it has enough room to just give your TP and go on. So these biases are really important. Now let's go to the channel. Look at this one. We can have the raw channel here. Look at this one. If it is the channel one, so we don't trade based on channel. Channels are just the only way to just show you the zones. Okay, so these are the zones that they have, and it also gives you boundaries to just show you the range. Okay, maximum range, the bouncing up and down. Okay, so it gives you just a rough idea. So what the average size of bouncing in each phases or each market cycle is. So now this one is the same thing, but for bearish scenario. So here you're just looking for sell, any reason for sell. Here you're looking for sell in the pullback based on candle pullbacks. Here you're looking for sell based on swing pullbacks. And here you're looking for sells based on, again, swing, but deep inside the swing and almost near the breaking out of the swing. Okay, so now, if you look at the boundaries of this one, okay, range, so it gives you a higher overbought and oversold area. Look at this one, we have difficulty actually drawing this channel, okay, but if you want to just draw a channel on that, you have to go as low as possible in time frames to just break into the channel phase. And the last one is last market cycle is trading range. So our trading range could also be choppy phase. Okay, it means that you could barely recognize that it is in the side way. As you know here, the momentum for the leg, if you just combine this to go to the higher time frame, you'll see that the leg there, the midline of this leg, it's kind of zero. Okay, the slope is zero. Okay, momentum of candle going up and down. Okay, the speed is zero. So in this kind of market, you're just looking for sell high and buy low. You're going to sell high, buy low. But there is one condition, and the condition is that it has enough room to give you enough range based on your cost of the trade. Okay, sometimes you're just trading CFD Forex, so they have wider spread, so it doesn't cover your expenses. Sometimes you're trading futures, but the range should be enough to just give you your required profit. Okay, and your stock will go behind the tensions here. So if it has wide range, so not only you can sell high and buy low, here you can break these legs in the lower time frame and consider them as one of the previous. Okay, if it is going down, so for example, this one could be this leg. Okay, in the lower time frame, right? So you need to just find its leg and find its overbought and oversold area and try to sell here in the overbought area. And here again, you're going to buy in the oversold area. The same here, which is so difficult if you're just no trader. And in the choppy part, whenever you're putting your stop here, sometimes they come and count your stop and go down into your target place. So that's why you have to be cautious enough not to trade in middle of this kind of market cycle, and better you have to just, if it is choppy, you have to just wait, okay, or you have to just consider how wide this channel is and try to trade based on the legs that they have. So it is not surprising that more than 65 to 80% of market is in the range phase. Any kind of range phase, it could be wide, it could be normal or tight range, or it could be kind of choppy. We can consider this trading range, but I put it here based on actually our market cycle, which is our sixth kind of market cycle. Trendy ones that you looked at, this one, okay, this one were trendy ones, okay, and breakout phase, the very first one, I could say, breakout and tight channels are really just, we can just see 5 to 10% of the market to be breakout or tight channel. 10 to 20% of the market is trendy. So, and as I already mentioned, each type of market cycle has its own type of setup and strategy. So one cannot be applied to another one. So now look at this clock here. So if you look at this one, we have 0, we have 1 to 2, we have 2 to 3, 3 to 4, 4 to 5. These numbers represent the strengths of the slope, okay, of our channel or our market cycle. So I could say this is a good representation for market cycle. When we have 0, 1, it means that we are in this kind of, this is 0, right? So if you look at this 1, 2, 3, 4, 5, Now look at this one. We have 1, 2, 3, 4, 5. So, and again, 1, 2, 3, 4, 5 for the bearish scenario. This is for longest scenario. This one is for bearish scenario. So then this one is for trading range and choppy market. So look at this one. Here, it is almost trading range. Okay, it means that you're buying high, sorry, selling high, buying low, selling high, buying low, if it is any. So, but its tendency is a little bit bullish. So, but anyways, as far as you just identify the trading range, you have to buy low and sell high. Trading range, BL, buy low, sell high. This is your bias. This one, a little trendier, but not as strong. It's a weak trend. Okay, as you see here, if we just see the pullback area, it comes and retests this one and goes up. Again here, it comes and retests and goes up. So this one is a wide uptrend channel. This one is wide downtrend channel. So in wide uptrend channel, okay, again, you're buying low, okay, and selling high, okay. So we usually just try to avoid buying two-sided, okay. You just take one side and try to trade in that way, because you don't need a lot of trades every day to be actually even millionaire using trading business. You just need 1, 2, 3, a maximum 5 trades a day, unless you're a scalper and you're just looking for some ticks here and there. So if you go to the other one, normal uptrend channel, here we have, and normal downtrend channel. So here you're just looking for buy low, okay? You have to wait till it comes down and you're just buying low. Then it goes up, comes down, you're buying low, goes up, comes down. So, and here the midline slope is 37, okay? And if it is normal, actually downtrend channel, you're looking for sell high. Here you're selling high, okay? So here you're buying low, you're selling high here. So the same, it goes down, you're looking for retracement, you buy and retracement comes down, you're looking for buy, sell and retracement. Now this one gets tighter. Here, just you're looking for sell in the bearish scenario, and you're looking for buy in the bullish scenario. There is nothing for the opposite, actually, no opposite bias. So now here, this is breakout or spike phase. So here, if you're looking for any sell, it doesn't make sense at all. So bullish breakout, which another name is, another word is a spike, just buy for any reason. It doesn't matter what. Here, you're just selling. Okay, that's the only way. Okay, now here we went from 0 to 1 to 2, from 3 to 4, and from 4 to 5, and finally more than 5, which is if you want to just put them in the group. So this is going to be our cycles. This is the most important things. This one happens in the higher time frames, legs, last leg. So you have to just break this legs into trends in the lower time frame and look for the opportunity to go here long and here short. So the same here, the same here. So you're looking for, you're going to hunt one of this leg here down, one of this leg here down, one of this leg here up, one of this leg here up, again here. So it's better after just finding out about these legs. So you go down to a lower time frame and try to buy here, buy here, buy here. So that's all about our lesson today. This is the most, I think, critical one that you have ever had. All the things that we have learned so far is just related to this lesson. Okay. See you next time and